Great. Welcome, everyone. Terence and I are very excited to be here with you today to chat about a topic that's on the minds of all our clients, and that's building savings. One thing to note today is that we're not working with you in a one-to-one session like we do with all our clients. So that means we're only able to provide you with general guidance. Please still feel free to pop your questions if you have any in the chat. But everyone's circumstances are different, so it's just important to note that this is not a personal financial session. A bit more about me to start. I'm Suzanne. I'm an accredited financial coach with Octopus Money Coach. I'm passionate about working with my clients to manage their money so they can save more, build their wealth, and achieve their goals.
And I'm Terence. I'm also an accredited financial coach. My goal is to help people clarify what is best for them and their loved ones, their careers and life in general, and work out the optimal roadmap to get there. Okay, well, let's get started. When we start working with clients for the first time, we begin by chatting about their goals, what's important to them, what they want from their money, what they want to change. And without fail, one of the things we hear from clients most often in our first sessions is this: I want to save more. I want to save more, but I keep putting it off. I want to save more, but I struggle to have enough left to save at the end of the month. I want to save more, but I don't know which accounts I should use. It's amazing that so many of us know saving is good and want to save, but so many of us also struggle with how to actually make it happen.
Just in case there's anyone who's not sure about the value of saving, let's talk for a moment about why we save. We all know what savings are, just a pot of money set aside that you don't spend on a day-to-day basis. Having that savings pot has lots of benefits. It protects you if there's an emergency and you suddenly need more money than you expected. That's happening a lot right now with the cost of living and energy bills rising. If you have some money set aside, then you're less likely to feel stressed when you need to tap into that extra cash. Savings are also easy to access when you need them. We're going to talk a bit later about the differences between savings and investments, but investments aren't a good fit for your money should you need access to it in the short term. Savings are great for that. So most of us have an intuitive, easy for you to say, most of us have an intuitive sense that saving is good, but we struggle with it or still feel that we could do more. Why is that? After working with lots and lots and lots of clients, I think there are two ingredients that are often missing that help us all save more and better. The first is motivation. All too often we stop ourselves that the objective is save more, but we don't take that extra step forward and get really specific about what we're saving for. Being clear on what you're saving for can make all the difference to your motivation to save. The second is habit. Most of us have inherited poor habits around saving, and that makes it more difficult than it needs to be. So we're going to talk about ways to make your saving easy and automatic. So that's where we're going to start today. Over the next 20 minutes or so, we'll cover motivation and habit. Then we'll talk about some different kinds of savings accounts. And finally, we'll go through some of the questions we get most often from clients. If time allows, we'll take a few of your questions as well. So please feel free to share them in the chat. If we don't get to your questions, don't worry. We'll answer them all in an email after the session. One more note on the things we're not going to cover today. This is not a session about investing, pensions, or building up your money for long-term goals. We've got other webinars coming up on these topics. Today we're focused on savings, savings accounts, and having money for the unexpected short-term goals.
Great. Let's talk about whether there are any scenarios when you shouldn't be saving. In general, building a habit of saving is a good idea for most people, but there are some situations worth considering. First, do you have any debts? In general, it's a good idea to consider paying off debts like credit cards or personal loans or utility bills, accounted arrears, before you focus on building saving. That's chiefly because you're paying interest on those debts, which is costing you money. For this purpose, we don't need to consider your mortgage or student loan debts, but have a think about whether you want to pay off debts first. The second situation is whether you have long-term goals that outweigh your short-term goals. I have a client who I recently caught up with who has 2 children in school. Now, we agreed her emergency fund was sufficient, and her next goal was she wanted to save for her kids' future, for university or a first home. So we needed to work out a split between what amount is suitable for investing versus upping pension contributions for tax considerations versus any other shorter term goals, when to change strategy, and understand what is optimal. Now, one question I often get asked is, should I put my money into a savings account or should I invest it? To make that decision for yourself, one of the key questions to ask is whether your goal is short-term or medium long-term. Savings are best for shorter-term goals where you'll need access to the money within around the next 3 years. Your money could grow more when it's invested, but the reason we always say only invest goals more than 5 years away is because investments go up and down, and they go down and up. So having a longer time horizon helps you manage the ups and downs of the market. As Suzanne mentioned, we're not going to talk about investing or pensions in this session, but it's a great idea to think about your goals along these timescales and realize that savings is best for those things you need money for in less than 5 years.
Now I want to talk to you about emergency funds. We usually think of an emergency fund as a reserve of 3 months' worth of spending. That's all of your outgoings for 3 months. Sometimes people think around 3 months of your take-home pay. 3 months is just a generic guide. It may be more or less depending on your situation. For example, if your partner is self-employed or has some more inconsistent work, you might actually want to build up more, but you can always talk to a coach to help decide what's right for you. So what's the point of this money? Imagine your boiler breaks down or your bills go up unexpectedly. You get in a car accident or you need to travel unexpectedly or you lose your job. I know these aren't nice situations to think about, but knowing that you have some money set aside will give you a bit of relief and peace of mind. I know from talking to my clients and from my own experience that some of our money stress comes from imagining those worst case what-if scenarios. By having an emergency fund, you can quiet your mind and remind yourself that you have some money to tap into in case of the unexpected. This is relevant to all of us, no matter how much you earn. One of my clients was earning well, but still living from month to month. The first thing we did was focus on building up their emergency fund to provide a financial cushion should they need it. It took a little while, but they made great progress, stashing away the cash at every opportunity in between catch-ups. Their trusty family runaround car packed up without warning. They were able to purchase a new one quickly using their emergency fund and minimising the disruption to the family routine. So I really suggest making one of your first goals an emergency fund. It will take time to build this up gradually, but don't worry if you don't have the full cushion now. Just one more tangible example of how this is going to quickly be valuable to you. It's very likely that the energy price cap will rise again in October this year. So believe it or not, our bills are actually going to go up again. Having this emergency savings set aside can help make these jumps feel less stressful for you.
Okay, so you've decided that savings are right for you. Got your emergency fund building up over time, and you're ready to go. But how are you going to get yourself motivated to save well? It starts with knowing what you're saving for and why it's important to you. Saving for the sake of saving can be really hard. It's much more exciting to know you're saving for something you really care about. You've probably heard this before. But our animal brains are wired to focus on what's in front of us, to get the thrill of instant gratification. We see that new pair of trainers and we want them. We see that delivery app and we want a nice delivery now. But there's other stuff we know we want that's not right in front of us. A holiday we want to go on, or a home project we have, or a party we're planning. Sometimes we don't even talk about these or think about these goals, which is why it's useful to also to have these conversations with people. Could even be a flat that you want to buy. So knowing that our brains are wired in this way, how can we possibly commit to saving for a goal that is 1, 2, or 3 years away when those trainers or that delivery is right in front of us? We need to wire our brain to feel excited about those other goals. We need to talk about them. We need to write them down. We need to visualize them in a lot of rich detail. Why they're important to us. What's it going to feel like to have them? What the first day of the holiday is going to be like. We get clear and specific about what we're saving for, and we create all these amazing associations and network in our minds. So take a second now, take a few moments and think about 1 or 2 specific things you want to save for the next 1 to 3 years. If you like, share it in the chat. Might even spark an idea for someone else. Now, here's what I'd recommend you do. Make a separate pot for each of your goals. Just like being a kid and having a piggy bank, these are your dream jars. You're going to keep these future dreams in mind every month when you're paying your fixed costs, your one-off costs, and your general spending. It's a very simple thing, but keeping them separate is important because it helps you remind your brain what you're saving for. And then each time you put a bit more money into that pot, it's like you're moving one step closer. Every time you have a look at this pot, let yourself imagine a little more about that thing. Make it more real in your brain. Make it feel as that delivery or that pair of trainers, because it is that real.
It is.
You just don't have it quite yet. So have a look and see if your bank offers this functionality. They're called different things, sub-accounts, jars, vaults, pots, but they probably do have something like this.
Okay, the second part of the savings equation is to make savings a habit. So let's start by talking about how most of us manage our money. We get paid, we spend throughout the month, and then we save what's left at the end. But I want to encourage everyone to flip this. We get paid, save immediately, and then spend what's left. We sometimes call this paying yourself first. Pay yourself before you pay all the other businesses and people in your life. So remember those clients we were talking about earlier, they said, I want to save, but I just don't have enough money left at the end of the month. And then they feel guilty and at the end of the month and beat themselves up. This is so common for many of us. But this trick can help solve that. When you save first, you can feel totally guilt-free about spending what's in your account, and that's a really good feeling. So how do we remember to actually save first, right after we get paid? And how do we remember how much we need to save into each of our dream pots? The answer is to make it so you don't have to remember. Make it automatic. Automating means you don't have to think about it. It just happens. There's a really easy way to do this that's offered by every bank, and that's by setting up a standing order, the exact same way we pay our bills. So going back to the pots you created with Terence, for each of those pots, you're going to work out how much you'll need and when. Divide that by the number of months between now and then, and that's roughly how much you should put into the pot every month. Then create a standing order. Just like you're paying your bills, it goes straight into that pot or savings account as soon as you get paid. So let's take a very simple example. And I know this feels really simple, but that doesn't mean it's always easy. Just because we know what to do doesn't mean that we all do it all the time. Say you know you want to book a big holiday next year, and you work out it's going to cost around £1,260. Dividing that by the number of months between now and when you've got that expense, and you work out you need to add £90 to your pot every month. If this feels obvious, that's amazing. This is exactly how to approach all of your near-term savings goals. Before we move on to some of the types of savings accounts, I want to challenge you with this question. Now that you know what you're saving for, and it's something that's really important to you, could you find a little more money to save for it each month? Maybe the answer is definitely not, Suzanne. But that's okay. But I just want you to ask yourself the same question. So often I hear from clients who say they have those amazing goals they want to save for, but just don't have as much money as they'd like to build up the savings. They have the motivation, they know how to make it an automatic habit, but they don't have enough to save. What you need to do in this case is look harder at your spending. So look back over the last 3 months and reflect where your money has gone. There might be some things you don't even realise you're spending your money on, like subscriptions you've forgotten about. Cancel it and add that straight into one of your savings pots. There may be stuff you bought that you regret when you look back on it. At least it didn't make you feel as happy as you thought. Could you pop some of that money into a savings on a monthly basis? Is there anything you can cut back on and roll into your savings? Remember, you're not giving it up completely, you're trading something now for something later. I've got clients who buy a coffee every day or nearly every day. In the moment, we don't think much about it, but look how that adds up. You can do the same activity with anything you buy regularly: alcohol, apps, takeaways, clothes. I'm not telling you to stop spending money on things that you enjoy and bring you joy. I'm asking you to think more about where your money goes and what you want to do with it. When you're looking at your spending, don't ask yourself, how do I spend less? That's where most of us start, and that's where we start feeling really unmotivated. I can't eat out as much as I'd like because I can't buy my kids as many clothes as I'd like because. Instead, ask yourself, how can I spend more on the stuff that really makes me happy? That might mean cutting back on other areas, but you'll start by cutting back on the stuff that makes you less happy.
Okay, now let's get into a bit more detail about where and how to save. So where do we put all this money we're going to be saving? We often put savings into special savings accounts that help us grow our money. The bank pays us interest for holding our money, this we know, and our money can grow as a result. Does anyone know what this number represents? 20,000 is the amount of money everyone can put into an ISA, it's an individual savings account, every year tax-free. There are different types of ISAs, which we'll talk about, but for your short-term goals, a cash ISA is usually best. So any interest you earn on this money isn't taxed by government. And on top of that, you've got another allowance for non-ISA accounts that might include things like the standard savings account at your bank. On those accounts that aren't ISAs, you don't have to pay any tax on interest. You earn up to £1,000 for basic rates taxpayers and £500 for higher rates taxpayers. I just want to be clear that you would need a lot of money in savings to surpass these limits, which is great news for all of us saving. When you're looking into different savings accounts, there are some different terms you'll see. So I would like to just explain a few of those here. With a fixed rate savings account, you lock away your savings for a set amount of time at a set interest. You'll often see high interest rates with fixed rate accounts, but the trade-off is that you often can't withdraw your money until the end of that period or contract. which could be 1 year, 2 years, or more. It varies by account. On the other hand, easy access savings accounts are one of the simplest ways to save because there are fewer restrictions or penalties on when you can take out your money. It's important, though, to read the details because some of these accounts still do have penalties, terms and conditions, and bonuses for different scenarios. Here are some examples of a few different types of savings accounts at the moment. There are loads of options out there. These are just 3 we selected to show you the range of what you'll see. And it does make sense and help to talk to a coach or talk to someone that knows a lot about these different products, depending on your situation and your tax bracket. I always recommend the website savingschampion.co.uk. They've got a live and unbiased breakdown of all the savings offers in the market. I think that most of us at Octopus Money Coach use Savings Champion. There are many out there though. They also help you understand the pros and cons of each account because it's important not just to look at that big interest rate. I've added a regular savings account example here too. You sometimes see higher rates with accounts like these, which require that you have a current account with a bank as well. So it's another way for banks to reward you to switch to their bank. So what else could you consider when choosing a savings account? So there are 4 tips that I would keep in mind. 1, what's the minimum I can start with? Some accounts will require a certain deposit to start. Some accounts also require that you already have a current account with the bank. 2, what's the maximum I can add each month? Many accounts have a maximum you can contribute. So, for example, the 3.5% first direct account we discussed a second ago only allows you to add £300 per month. 3, how often can I withdraw money? This is different with every account. Some accounts will be unlimited, but most will put a cap. For example, 2 withdrawals per year. And some accounts only let you withdraw when you close the account. And finally, 4, what are the conditions around bonuses and penalties? You'll often see exciting bonuses and extras advertised with accounts. It's really important to understand what the conditions of that offer are. Sometimes the bonus only applies to the first £100 deposited each month. Sometimes a bonus only applies if you don't withdraw anything for a set period of time. So look into the details. One last tip. One of the most common bonuses is to a special high interest rate in your first year with the account open. If you're the kind of person who wants to make sure they're always getting the best deal, it's now very easy to switch accounts for a better rate. If you're switching an ISA, take notes though. There's a really important thing to know. Never, ever withdraw the money when you want to switch. If you do withdraw the money and then redeposit it into a new account, it will count towards your 20,000 limit. So be careful because of those tax considerations. For ISAs, you can ask your new ISA provider for a transfer form and the money will be transferred that way.
I'm going to answer some of the most common questions about savings we get from our clients. But if there's anything you'd like to know, please pop it into the chat now and we'll use whatever remaining time we have to answer them as best we can. So, good question. Are my savings safe? The answer is yes. If your money is held with a UK institution, which is regulated by the Financial Conduct Authority, then you will have access to the Financial Services Compensation Scheme in the event that something goes wrong. That means that the first 85,000 of your savings, or 175,000 if your money is in a joint account, is protected in the event. And it's protected in the event that the bank or building society goes bust. And in case you were wondering if your money is safer stashed at home, most home insurance policies only cover up to £750 in cash if it's stolen. So it's probably better to find a decent bank account for your cash. Next question. What's the best way to save for the first-time buyers? This is a really common question that I work on with my clients. There is no one best way, as it will all vary for people with different situations. There are lots of strategies to save and prepare for buying your first home, and we couldn't possibly cover all of them today, unfortunately. But there is one I do want to share with you, and that's the lifetime ISA. The lifetime ISA can be used to help you purchase your first home if you're a first-time buyer. You add money to a savings account just like you would any other, and then you get a 25% bonus from the government for every pound you put in, or up to £4,000 every year, which can help you to get closer to that deposit faster. Be aware that there are some restrictions on what kind of property you can buy with the money. For example, the property has to cost under £450,000. And the only other catch is that if you don't use your lifetime ISA to purchase your first property, then you won't be able to access any of that money until you're 60 without incurring a hefty penalty. So you either withdraw it for your first property or in retirement. There are a few other scenarios, but they are very rare. And remember, lifetime ISAs are part of your 20,000 yearly ISA allowance. So it may not be right for everyone, but it can be an amazing way to save for a house faster.
Next question that often comes up is, what's the best way to save for family? Similar to the previous questions, there's definitely no one shoe fits all, one best way. But I did want to make you aware of some special accounts if you're saving for your children's futures. And that's junior ISAs and child savings accounts. There are many children's savings accounts out there, much like the variety you'll see in accounts for adults. The important thing to know is that kids have their own personal allowance, so can earn interest tax-free. There are also junior ISAs, which is a tax-free savings account, which is opened on behalf of a child. Accounts can be topped up by parents, friends, and family up to a limit of £9,000 in the current tax year. The catch is that these funds cannot be accessed until the child reaches 18 years old. But they can be great if you're saving for university expenses, for example. And if you have a longer time horizon between now and when the child is 18, you can choose a stocks and shares ISA and have the chance of your money growing more than it would in a standard junior cash ISA. It's also worth saying that next month's webinar is all around money tips for starting and growing a family. So there'll be much more in that session. And please do feel free also to invite any of your other colleagues from work to that too, if it comes up. Great. So we do have a question that has come up, and that is, where can we apply for a LISA for first-time buyers? Suzanne, would you like to answer that one?
Yeah, it's a good question, really good question. I think one of the first places I'd look into is savingschampion.co.uk to see what the best buys are in terms of lifetime ISAs. But they are offered as a product by most banks, building societies, and so on. Is there anything you'd like to add?
There is also, I can also add that Money Saving Expert is a wonderful resource.
Yes.
And there's a number of, they can really talk to you about the types of, if it's going to be a cash lifetime ISA or a stocks and shares lifetime ISA. Yeah. There's also quite a lot of options on reading up on what's right for you. I think I tend to see AJ Bell coming up a lot. I tend to see, I think it's, there's a Hargreaves and Lansdowne for stocks and shares. Worth taking a look at and doing a bit more research or talking to your coach about too. Okay, well, that brings us to the end of today's session. Thanks so much for joining us. If you ever want to talk to a financial coach and build a plan for your specific goals, we're both here. All of our coaches are here. Finally, please check your inbox later today or tomorrow. We'll have a look through any questions you asked and share answers to those questions in the email. We hope you have a great day, and bye for now.